volatility as we're going into the election week. And also starting with next week. So you're going to receive those love letters from your brokers very soon, in which they're going to raise our margin requirements, whether we're day trading or swing trading. All right. So without further ado, today I will be talking about profiting from market volatility using simple strategies. Definitely the one thing that we need to pay attention in a volatile market environment is not to be caught chasing the price. And this is the most important thing. So definitely a limited income and simple patterns. I'm going to share with you guys, some of the strategies that I use in today's presentation. Okay, for those of you that do not know me and are here for the very first time or hearing me for the very first time, my name is Anka Metcalf, and I'm the CEO and founder of TradeOutLoud.com. I'm a professional independent trader that is focused on day trading futures and swing trading futures and stocks. I have been doing this in my personal accounts for the last 17 years. And I have been in investment banking prior to becoming a retail trader, a professional independent trader. And I come with an experience of 10 plus years. I'm also the CEO and founder of TradeOutLoud.com, which is a trading education firm that is specialized in educating individuals how to day trade and swing trade the futures and the equities market. And we back it up by services that we provide. We trade to help our traders achieve their maximum potential. And I share all the trades that I put in my own personal account with all of my members. I specialize in high velocity moves. So what that means is that I'm looking for more reward to the risk applied. When I determine these high velocity zones, I take into consideration the price support resistance, but supply and demand only represents about 20%, less than 20% of the equation. Because I'm focused on confluence zones. These confluence zones are derived from overlaid support or resistance spots. So we need to have at least two or more support spots into the same location. This has to be in correlation with trigger times because I'm a day trader. When I day trade, especially futures, because I'm a full-time futures day trader. Well, if you call a full-time futures day trader, I only trade 2 hours a day. Anyways, we're going to get to that. So I look at specific trigger times. There are specific trigger times through the New York trading session that are prone to react into the futures markets. So these timings are 9:45, 10 o'clock, 10:30, 11:15, and 1:15, and that is for the first part of the day. We definitely have for the whole entire trading session, and these trigger times are applicable for the London session traders, and obviously they correspond to different times. I'm also looking for specific price zones. Institutions, when they decide to scale into trades because they cannot get in the trade at the same time, at the same price with all of their size, they scale in and scale out of trades. And these are specific price zones that institutional traders have positions on where, and these are very helpful. We teach those in our class. These are, like I said, these are not proprietary. These are proprietary because we're among probably the only ones that are teaching them. I'm not going to say that we're probably the only ones teaching them, but I haven't met a trader that, an educator that actually spoke about these levels, and we teach them in our course. They're the best kept secret of institutional traders. Let me put it that way. I look at chart synchronicity and divergency every single day before I put a trade on. Whether you're a stock trader or a futures trader, you have to keep a tab of what's moving and what's active in the market and what's leading or what's lagging. A strict set of trading rules and 10-point scoring system I also apply every single day to keep myself and my traders safe on the right side of the trade. If you guys want to get a hold of us, if you want to learn more about Trade Out Loud, you can head on to our website. We are going to have a website, a brand new website. Believe it or not, the website that we have is 10 years old. This is when Trade Out Loud came about. So we're a 10-year-old company. And we're going to have a brand new website, hopefully less than a month. So if you guys want to follow me on Facebook, on Twitter, YouTube, and LinkedIn, the handle is Trade Out Loud. I'm very active on Twitter where I put a plethora of trading ideas before they happen, whether you're interested in futures or you're interested in swing trading and sometimes even into day trading. Here's our agenda for today. We're going to talk about the stocks and the futures market and the advantages of both. We're going to talk about the steps you need to take to protect your portfolio, right? Especially now that we're heading full throttle into the election and we have a lot of price gyration because there's a lot of narrative that is circulating. We have Amy Coney Barrett's nomination for the Supreme Court. We have, and of course, the narrative is going to create the price gyration. The vote today created that gyration. In fact, we have time today. I'm going to share some charts with you. We have that wiggle to the downside today as the Democratic Party was speaking. Also, we are going to have a lot of chatter. Of course, tonight and into tomorrow, we have the presidential debate tonight. So experience, if you're a futures trader, you're going to see some gyrations that are going to happen into that time frame when that debate is going to go on. And every single day, plus the stimulus, right? Let's not forget about the stimulus. Today, we did have some narrative that came out around the stimulus discussion. And we did have, a lot of gyration around that, as well as Speaker Pelosi came on, and she said that, yes, we're making progress, but, they're really hoping to get a deal done into election. There's still a lot of things that they need to discuss about. I'm also going to provide you not a list of 10 stocks, but a list of about 30 plus stocks that you need to have on your watch list, especially as you're especially post election. Definitely this year has been incredibly volatile. The volatility came from the fact that, this is the first time in a very long time since we had, again, a pandemic. The last time around was in 1918, I believe. And when we had, I think, the Spanish flu, and now we have coronavirus. So anybody that is alive right now has never experienced a volatility like this. Nobody that has been trading has experienced a volatility like this. Volatility can be your best friend or it can be your worst enemy. We're going to discuss the odds and pros, the pros and the cons of trading volatile moves. And of course, the question is, will this volatility continue? And our technical analysis, and is technical analysis working? Well, news flash, working to the T. And the technical analysis has never worked better in the 2020 market, and especially that 2020 is one of these years where you could see technical analysis, basically, working at its best. And of course, day trading versus swing trading and volatility, which is best? Is it better to swing trade or is it better to day trade? Remember that day trading is dominated by a lot of algorithmic action. So the question to that is going to come later on. All right. So guys, there's some good news here. So if you lost money in the 2008 market, guess what? Make 2020 pay and learn from your experiences. There's every dip in the market, based on the technical level of retracement, can be a buying opportunity. So there are huge opportunities into the market. So we're going to talk about the advantages of the futures market in volatile market conditions and the advantages in stocks in volatile markets. But first of all, let's tackle the futures market. First of all, the futures market, there's no minimum account size. Like in the stock market, you need about $25,000 and you basically need about $30,000 in order to open a day trading account. And guess what? If you open it with just $25,000, you lose a cent. Guess what? Your day trading status is out the door. So in the futures market, you're trading, huge big markets. Your margin requirements to open your minimum requirements to open an account is $5,000. I don't believe in that. $500 open an account into the futures market. Please stay away from that. If you don't have the money to open a futures account with $5,000 or more, please stay on the sidelines or use a prop trading account. You can trade really big markets, the S&P, NASDAQ, Dow, Russell, crude oil, bonds, gold, and other commodities. And unlike individual stocks, which are small components of the index, so you're trading really heavy markets. you're trading major, like I said, major markets, really heavy markets. Whether you trade it for income or for wealth, the difference between the two is basically income is day trading. You're, in and out of a position within the same trading day, and swing trading, you're going to hold the position until targets are hit. And that could take several, couple of days to several days. Also, tick values and price ranges, they're different for every pocket. So which allows trading the market and price point that matches your account size and your comfort level. For instance, the Dow, the Dow is $5 per point. If you're trading the mini S&P, a point is $50. If you're trading NASDAQ, that's $20. And of course, there is a market for every trader and for every budget. And of course, last year we had the CME that has introduced the mini micros, which was the best decision ever, because a lot of traders blew their accounts up in 2018 when we had the last volatility in the market. And we're going to talk about that as well, and actions and what we have learned and the takeaways from 2018. But micros are amazing. There were a lot of missed opportunities for, a lot of traders in 2018 because volatility brings really wide risk levels because of the price ranges. So the micros are a way in which you can position size for that trade, and allows retail traders to participate in swing trades and participate, in active investing trades, if you will, in a more safer manner, with a position that is afforded by them. You also have reliable market volume. Let's not forget that, the futures market is an extremely liquid market. You have $600 billion daily turnover, which allows instant execution. Just a quick note here, even the Asian session and the London session are really very, very active. And one of the things that I wanted to mention here before we have, continue, because I don't want to forget this, on election day, that specific day on November 3rd, there's going to be massive volume in the Asian market and into the London session market, not only into the New York session market. And that is because all of the firms, hedge funds, institutional traders, they're going to be on call, just as doctors are on call. Okay. Now the traders are going to be on call. This is a norm in this space, into the trading space. So all the trades are going to be at their desks to monitor the trades because of the increased volatility. Leverage, low margin requirements, and very low commissions are some of the biggest advantages of the futures market. One of the biggest advantage for me is that it's simplified trading, because if you're like me and your bread and butter is only 4 charts, basically the futures indices, you don't need to use a scanner, which is an additional cost. I use a scanner because I'm a stock trader as well, and I use it for my swing trading. So I only swing trade stocks or active investing in stocks. I don't day trade stocks. I used to do that for more than 20 years, and I've discovered a simple way to trade. Even though it was hard for me to navigate away from stock trading, I navigated towards the futures market for accounting purposes and for tax purposes. So, which brings me to tax advantages. There are multiple tax advantages for the futures market that otherwise you don't have into that you don't have into the stock market. And definitely when you start making money, you have to look at tax advantages and what makes sense for you to pay less taxes. You also have simplified reporting at the end of the year. You just receive a 1099-B form from the from your broker, that you could actually, do the taxes yourself. You don't have to hire a trading accountant, because trust me, they tend to be very, very expensive. And I am there, I'm doing it. So I'm telling you, it's kind of run up because I'm still trading, stocks, from swing trading. And of course, here in the US, you have the 60-40 rule. If you're trading outside of the US, especially in UK, OMG, what are you doing? You should be getting into the futures market. Read the regulations there. It is the place to be if you're a trader. UK is the place to be. You could take on a short position with these because there's no uptick roll. For those of you that are day traders, you know what I'm referring. There's no pump and dump. It's safe from rumors. There are no manipulations. There are no downgrades or upgrades in the futures market, and they're great for hedging. And one perfect opportunity now, as we're heading into a maximum volatility space into next week and election week, you could definitely have huge advantages with hedging in the futures market. And not only that, but it's a 24-hour market, especially in volatile market conditions. If you put on swing trades, or even if you put on, for day trading, that's not a problem. But if you put on swing trades, you have the hands on risk approach. What that means is that as the price, let's say, is heading your way, you have a long position, let's say in NASDAQ or in the SPX, you're able to manage it 24 hours a day. So let's say you get the election results at 11 or 12 o'clock or 1 o'clock in the morning. Let's say the price reaction is going to go to the upside in your favor. You can actually chunk those profits out. You don't have to wait to the next day, because guess what? By the next day, the price can be back to ground zero. All right, so let's talk a little about the advantages of trading futures and the advantages of trading stocks. So let's say a trader wants to purchase the Qs, which let's say they're trading at $280. The trader needs about $14,000 in buying power. And of course, this is, again, a bit higher margin requirements because of the volatility. So if the price is going to go up, let's say 50 cents, you're going to profit for about $50, which is not bad because each penny represents $1 on that move. But let's say a trader wants to trade the mini NASDAQ, right, which is priced, let's say, at 11,500. The trader needs about $17,000 in buying power, and this margin requirement has increased pre-pandemic, so it has increased in February because it was way lower than that. It was about $12,000 to $15,000, and now it's $17,000, and that is because of the 2020 pandemic environment. And if the price goes up 50 points in let's say in NASDAQ minis, you're going to profit about $1,000 because each point is very heavy. It's $20. So the next thing that, a lot of traders ask me at this point is like, oh my gosh, but if I'm trading, let's say the Qs, I'm going to have, a smaller loss compared to if I'm wrong, I'm going to have a greater loss. Wrong. Absolutely, completely wrong. And if you don't know how to position size, I highly suggest before you get into any trade, shut off your platform and anything, go to the drawing board, Google how to position size. And once you learn the position sizing concept, then you can get back into the trading. Because the number one reason traders blow up their accounts is because they have no idea how to position size. And of course, there's this misconception into the futures world where, let's say you have a standard size account. Let's say you have, I don't know, a $30,000 account size, and you're going to go like, I'm going to trade 3 contracts at a time. That couldn't be any wrong, because you're going to have a fluctuation in your account. You're never going to make money. Not unless you're really amazing at trading, because the key here is to use the same risk amount on every single trade. Listen, the difference between the entry and the stop is always going to vary. There is no such thing. And I've heard traders that say, oh, I'm giving it a standard of 2 points. I'm giving it a standard of 5 points. That is not the way to trade. I'm sorry to break it to you. I'm coming from the institutional world. I've been doing this for over 20 years, and I could tell you right off the bat, you're learning the wrong thing. So be very careful where you're getting your education from, because this is wrong, cannot be any wronger than that. Because the difference, the risk should be determined based on the entry and the stop. So this amount, this number varies. The price varies every single time. Sometimes you're going to get a shallower pullback with a trigger price and a stop area. So you got to make sure that you look at these rotations and know exactly what a buy setup is, exactly what a sell setup is, so you know how to calculate your entry level and your stop level, because the risk is the difference between the entry and the stop. And you cannot squish 5 points over here, because you're going to stop out of the trade 99% of the time. You're never going to make money. So basically, I'm going to share with you an example by using the approximate same buying power into the futures market and into the stock market. This is a chart of the Qs. You can see it right here. The trade duration was 20 minutes. The trade was initiated at 10 o'clock. 10 o'clock is one of the very important times into the futures market. And we waited for a pullback. We waited for a rotation. This was our entry candle right here. And this was our stop low. We had our target right into this prior high. And we took our profits. So with 100 shares using about $14,000 in buying power, we made $73, which if you think about it, it's like pretty cool because this is in 20 minutes. Okay, well, let me show you the same results trading the NASDAQ market, trading the futures market. This example of NASDAQ, the trade was initiated at 10 o'clock. It was the same rotation that happened into the market. This was the entry, this was the stop. And the trade happened at 10 o'clock. The trade duration was 20 minutes. We traded it with, I traded this example with one contract just to show you that on the same risk amount that you're using, right? The risk remains the same, right? You position size. So let's say if you have an account size of $30,000, okay? And if you're risking 1% per trade, that's $300 risk per trade. So what that means is that you're going to position size, whether you're going to use micros or full size contract, depending on the risk level, the difference between the entry and the stop and your position size. It's a very easy concept. If you learn how to do it, if you learn this concept, the position sizing concept, and how to apply the same risk on every single trade, your account is going to grow exponentially. You're going to make a lot of money into the end of the year. And next year, you're going to say, oh my gosh, there's a simple, quick thing that I fixed and I'm profitable now. Because the problem is that if you're applying, let's say $200 on a trade, $500 on a trade, $800 on a trade, it's going to be really hard. And if you incur those 3 losses, let's say you have those 3 trades that I just mentioned, and if you incur 3 losses, guess what? Guess what's going to happen? You're going to have mixed results. The trade where you're going to risk the less and you're going to say, oh, I chickened out, you know, I'm not going to use that risk anymore. I'm going to do this, this, and that. And that is the trade that's going to work for you. Okay, that's the trade that's going to work for you. So I'm going to ask you right off the bat, are you willing to trade the stock market and make $73, or would you rather trade the futures market and make $600 and pretty much with the same risk? Okay, pretty much with the same risk. All right, biggest advantage in the futures market, monitor and manage positions in a 24-hour market. Like I said, it's a hands-on approach. No gap surprises except the halts and the limits down that we had, and we can still trade them. We have transitioned through March and April, through February as well, when the volatility was at its highest, and we actually had the best results in trading. In stocks, you can have a surprise every morning. It's volatile market environments. Try to put on a long position or even a short position before the election. The election is going to be a total surprise in terms of price action for the market because nobody knows in advance how the market is going to react. So here is another thing that influences volatility into the market. Usually the first 6 weeks into earnings are the most volatile. The reason for that is because we're in full swing earnings season. Earnings season is most active in the first 6 weeks. After that, it damps down, as you can see it right here. See the red arrow? This is where we are this is where we are right now. And next week, we're going to be at 15% of the companies are going to continue to report earnings. And then this is the election week. So this is where we're going to experience not only volatility from the election process, but also we're going to experience maximum volatility from earnings, from fundamentals. They're going to be reporting. They're going to be right on schedule, report. And this is the time when Apple, Google, Microsoft is reporting earnings. And again, add the election process to that, and you can imagine what kind of trading experience we're going to be having on the week of November 2nd, November 3rd being the election. But we're still here. We're still having mild volatility. Yes, we're still having volatility, but don't forget one thing. When you're having a major trend, any kind of volatile pullback is going to be a buying opportunity because the trend is still intact. And in fact, the Dow or the diamonds, if you're watching, the S&P or the SPYs, if you're watching, NASDAQ or the Qs, if you're watching, Russell or the E-mini Russell, if you're watching, they're sitting on massive support right here. So any gyration to the downside is going to be a buying opportunity. So let's talk volatility. Every once in a while, the markets will become volatile for various reasons, whether news or geopolitical events, election, unrest, etc. There were different volatility cycles from 2000 to 2002. So this is not new that is happening in the market. It is a cycle of volatility moves in cycles. From 2000 to 2002, we had the internet bubble. In 2008, we had the financial crisis. In 2018, we had volatility exposure spike due to trade wars between US and China. In 2020, we have the coronavirus pandemic so far. So I'm going to give you this, I'm going to give you, a little bit of definition so you understand what volatility is, so we can talk more in depth about how to tackle and what strategies to use. So volatility is the amount of unpredictability or risk in an index, stock, commodity, etc. A higher volatility means that the security's value can oscillate in a larger price range. So it's going to gyrate back and forth. In other words, the price of the index, the stock, commodity, etc., can have a higher than average fluctuation rate over a very short period of time. So when you're experiencing and when you're trading and you're seeing, on the time frame that you're trading, that there are, let's say, a lot of topping tails or bottoming tails, that is, and wider wicks, definitely, that is a sign of volatility. Those wicks are created by multiple factors. One that I can share with you here is that there are going to be algo triggers that take the price higher, and then algorithms go for very short targets, and they're going to pop the price back down, because once they achieve target, they sell and they bring the price back down. So a lot of times you're going to see that when the candle opens, and if you're having those doji candles or hammer candles, they're going to go up and then they're going to go back down. And this is a very typical volatile environment. A lower volatility means that the index, stock, commodity, etc. value does not move dramatically, but at a normal pace. So if you have been trading in 2017, we did not have any volatility. So that was a boring way to the market, because it was a very profitable year, even though we didn't have volatility. So what causes volatility and what are the triggers? Well, like I said before, geopolitical events, a climactic hyperextended move in the market, similar to the one we had in 2018, and 2017, we had the extension into the market. I'm going to share some charts with you in a second. And in 2018, the volatility kicked in. Earnings reports, and like I said, we're in week 2 in earnings, and next week we're going to go a little bit more into earnings, and then, like I said, into election. It's going to be full throttle. Algorithms, they buy and the buy and sell programs that are hitting at certain targets, and I'm talking about institutional algorithms, okay, not algorithms that are developed by each trader or smaller companies. I'm talking about the institutional algorithms here. Epidemic, pandemic issues, etc. So the next question is volatility good or bad for the trader? Well, there's some pros and some cons. Let's discuss the pros. Tremendous technical opportunities for the astute trader. Money's being made in a fraction of the time compared to the traditional market moves. In fact, if you go through my portfolio, it's on our website. If you hover your mouse over the trading room tab, you're going to see our performance. And our performance went through the roof with massive gains. It was my best year ever that I've traded, and I've traded the .com era. I've traded the 2008 financial crisis, and I could tell you right off the bat, the best day trading results that I've ever had, and also swing trading results. But in swing trading, I was a little bit more reserved. I had less trades throughout the month of February and March, because being engaged in swing trades is very risky business in a pandemic where you have to wait for price evidence. So basically, if you know what you're doing in the market, you can have incredible results. Profitable for short-term trades, so day traders are going to thrive off of these moves. As price seesaws back and forth, short-term traders can use chart patterns and other technical indicators to help time the highs and the lows. I use the Williams percent R that helps me. And we nailed the correction that came into March, and we were full throttle along from that point on. You could go scroll through our portfolio and you could see that most of the trades from that point on were all long, not one short that we had into the portfolio. We use very simple strategies. We actually have 4 strategies that we deploy into high volatility, and we teach those in our course. They're basically the inside strategy. We have when the price calms down and trades within inside a range, a tighter range. We have the pullback and rotation on smaller time frames with the roll in, on higher time frames. So we're waiting for a price evidence on the 5-minute over the rotation from that volatile drop. And we're legging in. That's the only time when we scale. And as it rolls into the 15-minute, if it triggers the 15 rotation, if it's doing the green to red, if it's doing the green to red on the 15-minute, we're adding more. If it's doing the green to red on the 30-minute, we're going to add more, and so on and so forth. So we're rolling in the trade. We're not buying as the price is dropping. We're buying as the price is going into our favor and is triggering for new highs. And this way, you're going to be able to make monster profits in a volatile market environment using very simple strategies as a pullback buy. Not an environment for swing trading or investing. So, to answer your question, how do you swing trade or invest in a volatile market is definitely you have to wait for price evidence. You can swing trade, and we did have swing trades in our swing trading program. We were looking for unique trading opportunities. Those unique trading opportunities, were because we're talking about swing trade, stock swing trading, ZM, which you can see where it was back in March and where it is now. So we were looking for the safe haven stocks and stocks that were COVID safe. All right, so let's talk about the cons, right? So, definitely why 95% of traders blow up their accounts is because they go full throttle into volatility. They don't have they're not specialized in trading volatility. A lot of traders, start mid-cycle between volatile environments, and when they run into a little bit of volatility, they have no idea what hit them. So one of the cons in volatile markets is that the stops are going to be very wide. And that is because of the huge price fluctuations, and setups become very difficult to take because of that. But now they're not as difficult to trade because you can leg into these specific trades with micros. Of course, typical volatile environment, in a typical volatile environment, you're going to encounter multiple stop outs, but there's a good side to that, because once you know that you have multiple stop outs within this period of time, you can adjust your position sizing. So remember what I was saying before, that you need to have, risk your 1% per trade. Well, there's a way to do that. Knowing that you're trading in a volatile environment and you have more odds of stopping out, guess what? You're going to use 0.5%. So half of your risk. And this is always better, because if you stop out in 2 trades, it's going to consume just one of those risk levels that you have allocated for the day. So you can take more trades, because definitely any kind of trade setup in a volatile environment has about 50% chance of working out. Very seldom cases that they work right off the bat. So I took some volatile trade, last week, and even yesterday, and even today. I stopped out the first time around, and then the second time, the third time it worked. So you can stop out once or twice, and the third time when it works out, then you work the trade out. But you have to have maximum patience to wait for the setup, because remember, if you have a setup, it's very easy. So in trading, they're very simple rules. You have a trade, you have a setup, you have a trade. You don't have a setup, you don't have a trade. And there's no such thing as, oh, I'm impatient, I get into trades too quickly. The question is, why? Don't you have 2 eyes to look at the setup that the candle is not completed? Like what? If you're trading a 5-minute chart, wait for the candle to complete until you have price evidence. There's no such thing as you don't have a patience. It's not that you don't have patience. Those traders that admit and say, hey, I'm getting in the trade too early, I don't have patience to wait for the trade, those traders are completely uneducated. It's not that they lack the patience, they're uneducated. So stops are very wide, making it impossible for retail traders to participate in, and impossible for small account holders to take part in any trades for days. That is one of the downsides. Now, let me share a chart with you guys. And I took the snapshot yesterday and I did this chart last night. And this is the black swan. Okay, I don't know. My mouse is not working here for some reason. Okay. Lost my, okay, here it is. Okay, this is the black swan dive. If you don't know what a black swan dive is, I have a video on YouTube, and I'm talking about the black swan. It's easy to identify what that video is. It's on youtube.com/TradeOutLoud, because it has the swan on the cover. Okay, so it's a black swan. So this is the pullback pandemic right here. Okay, prior to this, we had different volatility cycles. The prior volatility cycle was inflation, with the inflation fears. You can see them right here, and these were from 2018 and through 2019. And remember that I said that we started to be a bit more. We started the volatility, not a bit more. We started the massive volatility in February. This is the first week in February, and this is what it brought right here. And this is after a non-volatile environment. In fact, from the US election, we just had a massive uptrend, extension. We're hitting new highs, and after those new highs were hit, we started getting narrative, and that narrative impacted the price. It was inflation fears, North Korea, we had Syria. Remember North Korea? Okay, Syria and the trade war. And this created the gyration in price to come back into the 50 SMA, go back up, revisit the 50 SMA before trajectorying higher, which is normal during this period of time. And remember that the next volatility is always coming in October. October is known as the most volatile month of the year. The months of October, November, and December carried the heaviest volume from the year. You're not going to encounter the volume that you're encountering in Q4. It's not in the market in Q1, 2, or 3. And this is actually, let me just see where my mouse is. Okay. And this is October, November, and December. And do you guys know when this bar rotated here from this 200 SMA? It was on December 26th. It was the Santa Claus rally bar. Okay, it was a Santa Claus rally bar. And we teach this in, how to trade like a hedge fund. And we were buyers right off the bottom right here because we knew the timing in the market. All right, and we took the price higher. Now, prior to that, this was the US election, and we had the volatility in the US election. We had a little bit of a, the pullback, and I was trading actually the Dow on last election, and I picked it up from 17,500, and I was able to get like, I don't know, I think like 1,000 points in it or something like that. Crazy. It was just awesome. I didn't have a lot of size. I only had one contract, just a quick disclaimer. So I didn't go all crazy, but it set me up really good for this rally. So I had, a really good result with that. There was the Brexit, if you guys remember Brexit. These are the falling oil prices, if you guys remember, in 2016, and the rotation. This rotation happened in March, on March 2nd. We also had the China unrest, and we saw the volatility. This was the China unrest. And we also had the Greece issues. Remember, Greece was defaulting, the European Union, right? Greece was defaulting. We had, again, volatility. So markets that are not in the U.S. affect the U.S. markets, okay? Because you could see here Brexit, you could see the falling oil prices, you could see China arrest, and of course here we had another volatility on growth concerns. So in volatile market environments, you could definitely make more money faster if you know how and what you're doing in the market. Or you can lose it all if you're uneducated and just do not know how to position size, do not know how a setup is formed, do not know what a setup is, and definitely technical analysis. In 2018, 374 hedge funds have closed their doors because they were fully engaged into hedging activities. And hedging is great, and I use hedging as a strategy. And even now, I have a position in the VIX. That is to offset potential losses that I may incur in the rest of the positions that I have on, because I have only long positions in my stock a stock swing trading account and my active investing, and I want to put a position, and I put a position in the VIX in which we made some money. We still have it open. We took some profits, so we're going to play around with it, and we're going to keep it into election because this is going to balance our portfolio. So if our stocks are going to take a dive, the VIX is going to go up, and it's going to offset our portfolio. So we're going to have a really nice balanced portfolio. We're not going to say, wake up one morning and say, oh my God, the market is down. I lost everything in all those stocks. They stopped out, or I didn't use stops or whatever. But if you have positions in the VIX, which is the fear factor and can be traded, I trade the VIX. I trade the VXX because I don't trade options. If you should choose to trade options, you can choose the VIX. I don't like to do that. And I don't like to trade options, and the reason for that is that they expire, and I don't want my position to expire because I'm using my position to hedge and to leverage. This is a collapse that wiped out tons of money into the market. And of course, this is the GDP. As you can see it right here, minus 9.5%. That actually came up right now, and it's right here somewhere. It's into the mid ranges. So coronavirus wiped out about $13 trillion in the US stock market in March. But here's the thing, there's always someone on the other side of the trade. So don't think that if the market goes down, institutional traders don't profit from that move. Of course they do. So volatility is what pushes the price faster to the target and is the number one opportunity for the astute trader. So I have traded the 2000 to 2002 dot-com bubble. I traded the 2008 and I thrived at the end of 2008. I started to pick up some stocks. I still have some stocks from there in my active account, in my active investing account, and my actually my retirement account. I've traded the QE years that shortly followed the 2009. I've traded through election cycles, multiple election cycles. So you can imagine from 2000, I've been trading for over 20 years. Like I said, I've traded through Brexit, China trade wars, and the 2018 volatility. And of course, 2020, bring it. We are prepared at TradeOutLoud. So making money in any kind of market environment is possible. So trading, the reason why, I'm saying all this is that I don't want you guys to fear of the market. There are strategies that you can employ, and having the patience to wait for these opportunities that are coming in the market can be a gold mine for traders. You could harvest a lot of profits from this volatility. Trading is a recession-proof job. Guys, I have no idea if there's going to be a second wave of coronavirus. I have friends in the UK and they're going on lockdown. They are in lockdown right now. So, be prepared. Have, a plan. If you're going to be locked down, if you're not going to go to work, or if you lose your work, trading is something that you can get into. Even if you don't have a trading account, or if you have a very small trading account, it is doable for every level trader. And more so, even if you don't have a trading account, there are ways in which you can have funded accounts. So here's the difference between day trading and swing trading. Day trading focuses on smaller time frames, so you're hands-on price action. It is an income-producing style of trading because you're in and out and you have access to your cash. If you want to go and, buy something, buy a couch or a TV, you would definitely have access to your portfolio, and you can take that money away. Versus swing trading, where if you're in a position, let's say I'm getting in the S&P long now as let's say in a swing trade, or I'm getting into SPYs, or I'm getting in Apple, until Apple reaches targets, which may be in 2 days, 5 days, or 2 weeks, or 3 weeks, depending on the market environment, my cash is locked up in that account. So I don't have access to the cash. So even if I see a great deal on Black Friday, I can't get my cash, right? Because my cash is locked into the trade. So this is the advantage day trading versus swing trading. Day trading is for income and swing trading is for wealth. All right. So can volatility be forecasted? And if there's a way to know when we can expect volatile moves. And yes, somewhat, although not with an exact precision. Volatile moves at times are predictable, and sometimes they're unpredictable. But even with coronavirus, it was pretty much predictable. We knew that, ever since, you saw people and guys, you watch TV, you saw people falling on the streets in China. They were talking about coronavirus, so it was getting very bad there. It wasn't hitting, the rest of the world, but you could definitely see that it was a high impact. It was a high impact for them. And we even saw a minor volatility in the market at that time, because we saw some price gyrations when there was narrative, when the number of infected coronavirus patients started to increase in China, when the death rate started to increase in China. There was definitely some volatility in the US market as well. So the predictability comes from technical patterns. If you master technical analysis, and I mean master technical analysis, you are going to make a lot of money in the market. So how to trade volatility? Number one, long-term investors will use hedging strategies to minimize the risk. Inverse ETFs or the VIX, VIX or VXX. Medium-term traders will speculate on volatile moves by buying pullbacks into key reversal prone support zones and trading markets, and also use hedging techniques. And number three, day traders will trade both facets of the coin. They will go long and short based on the momentum and based on the technical levels. So what are the cons of volatility? Like I said, traders may often stop out because of the steep risk and because they need to maintain long-term buys for their trades. Stops are far wider, and risk to reward is high compared to the reward. So it's always an asymmetric environment. And by the way, if you're trading the futures market right now, this is a highly asymmetric market environment, because we have been sideways for about 2.5 days. We're trying to rotate and go back up, but guess what? We're still trading into the chop from yesterday and the day before. So we have a lot of overhead resistance. Also, if you're trading the Qs or the SPY, so that's why they're not gaining the velocity for higher. So definitely the market is waiting for a positive narrative in order to digest those levels and start making new highs. The reason why every pullback is bought into the market is because we're still trading, like I said at the beginning of the presentation, into a massively uptrending market. And of course, one of the other disadvantages is that the markets move very, very fast. And sometimes you're likely to miss entries, because by the time you're calculating the parameters and you have your cursor over the setups, and by the time you're looking at the highs, the lows, the risk, and you're calculating everything, you can miss the trade. In fact, we had an example today in the trading room where I was like focused on getting long into the market, and it happened so fast. But by the time the setup completed, and I was still reading the information as to where I need to have my entry, my stop, and where I need to have my targets, because all the homework is done before you get into the trade and not after you get into the trade. The trade already triggered, and it went massively in less than 3 minutes into all the targets. So this is a big disadvantage of volatility, because you may miss some moves. And of course, the slippage is the next one. Now, here are 10 steps to protect your portfolio. Number one, reduce your risk exposure as you're getting closer into election. Minimize your risk. So like I said, I mentioned it here at least 2 times. Don't go full throttle size. Just, take a quarter or take a half. And remember, the rule of thumb is when you're, half the size, double the stop, so you don't get wiggled out. So you include those big tails to the downside or to the upside if you're shorting. Sit on the sidelines and wait for price to slow down. When the price is very, very fast, I tend to slow down, and I tend to look for that best possible optimum opportunity for a price confirmation and the trade to go my way. Do not ignore news, and always be on the lookout for any kind of news that is coming out through the wires. Do not sit complacent and trend saying, oh, I'm underwater, I didn't take my stop here, but I'm holding this trade, because that trade may break your bank. So in other words, it's going to blow up your account. Also, use stop losses, use hard stops. Like I said, use hard stop. Don't use flexible stops or soft stops as you're getting into these volatile markets, because they're very whippy. Diversification is something that you need to have in your portfolio, especially if you're a stock trader, if you're a swing trader. Don't put your eggs in all in one basket, okay? So use non-correlating assets. Invest in high dividend stocks, you know, stocks like Home Depot, Procter & Gamble, etc. Stocks that are even COVID pandemic safe, and prepare in advance for market crash when you have that predictability factor. So stocks to have on your radar, and these are lockdown safe stocks. Now, we had a presentation, it was a different presentation that we had in March, I compiled a list of stocks for my personal account. Every technical dip represented a pullback opportunity, and I have a lot of traders that obviously are in my program and have never lost sight of these stocks, and we have traded these stocks and we have literally pounded them over and over and over again. You know, stocks like Chewy, you know, stocks like Piton, stocks like Apple, stocks like ZM. I mean, take a look at the charts. And by the way, this list was made public by us in March 2020. Take a look at 2020 in ZM, and take a look at March 2020 in ZM, and then take a look at where it is right now. Take a look at Target, Johnson & Johnson, Procter & Gamble, etc. These are pharmaceutical stocks that, again, they're working on a vaccine. And remember, this was in March, guys. This list was in March and is still valid to this very day. So keep this list handy. The difference between successful traders and unsuccessful traders, well, the differences are very easy. Successful traders are really well prepared, because newsflash, in trading, there's no average. You're either fantastic and you're really great at trading and you're making money, or you're not good at trading because you're uneducated. You have no idea what you're doing in the market. And of course, you're blowing up accounts and you're losing. You have losses after losses after losses after losses. So you have to be a really well-prepared trader, not only for this market, but you know, and in this market, volatile markets are natural selection for traders. We call them natural selection for traders. Definitely retail traders, and I do have, you know, 3 really good friends that are brokers, and they're telling me that every time there's a volatility spike, all of these small accounts that are being opened with between $5,000 and $500, they're getting wiped at a rate of about 97%. So if you have been losing money in volatile market environments, you're not alone. You're part of that 97%. But don't you want to be into that 3% that is actually making money? And they're prepared. You know how to mitigate the risk. You learn from your failures. You always adapt, because the market is always adapting, and you believe in accountability. Unsuccessful traders wing it. They get into a trade, they go like, oh, I'm going to add a little bit more here, I'm going to do this, I'm going to do that. They wing it. They don't have a plan. They have a plan as the price, you know, progresses. They have no idea what they're doing in the market. They ignore the risk. Like I said, you know, it's very simple. You have a $30,000 account and say, hey, I'm getting a standard of 3 contracts, and they don't position size. Your P&L is going to be all over the place, because your risk is going to be so asymmetric. It's going to be really hard to grow that account. The odds of growing an account with using standard sizes based on your account size is of 2%. So that's how low it is. We teach an institutional grade trading system. We have a class that is starting this Monday. We're almost sold out in the class, just letting you guys know. We only have 3 spots available for Monday. So we're going to teach you how to trade stress-free institutional levels with precise buy areas and sell areas. We actually teach you strategies. We have 10 strategies that you can employ in the market depending on market environments and market conditions. We teach high odds patterns and setups, and how and where to place your stops so you don't get dinged out of trades all the time. We'll teach you also trading psychology, and most important for all is how to put the puzzle together. Because guess what? You could go on the internet, you could go on Amazon, you could buy 20 books of technical analysis, 50 books of setups. You can look at probably 20 DVDs on how to trade and how to do this and that. Trust me, the one missing link that nobody's talking about is how to put everything together, how to use technical analysis and correlate that with your entry, and how to determine the targets. These are things that we teach in our course. We teach you the anatomy of the trade, how to calculate precision laser sharp entries, how to calculate stops, how to calculate position sizing, how to calculate the targets, how to react into targets. Because a lot of traders, let's say they enter into a trade and they go like, okay, I'm going to trade. What happens if you hit target 1? What happens if you hit target 2? What is your reaction when the price is achieving those levels? Are you leaving the whole entire lot there? Are you peeling some? Are you scaling out? Are you moving your stop? What are you doing? So these are things that we teach exactly with mathematical precision, what traders need to do. So we teach the most powerful day trading patterns and how to exploit them for above average gains. Because if you look through our portfolio, we don't have average gains, and we are going to teach you how to achieve those fantastic returns by being disciplined and applying the strategies that we teach you at the certain times. Because a lot of traders have trades that initiate trades, and they go like, oh, but it triggered. I mean, how many of you guys in here had a trade, it triggered, it went up and then it fizzled out and it stopped you out? A lot of times, right? A lot of times it happens to traders all the time. This is the number one thing that I'm hearing from a lot of traders. The reason for that is because they initiate the trade at the wrong market timing. Okay. We're also going to teach you the market tempo, because the market has a cyclical tempo. When it's more prone to pulling back, when it's more prone to ascending, when it's going to decline. So we're going to teach you all of those phases. We teach you the 6 major disciplines: the entry, the stop, the target, trade management, position sizing, and trailing. These are a must. How to maximize your timing using key moving averages and other powerful indicators that, guess what? They're free on any platform. There are just a few moving averages, in volume, etc. So there's simple indicators, and you're going to learn how to read pure price action, how to maximize gains and minimize losses using proper money management techniques, and how to react into targets. Market timing, precise timing, when to act, when to buy or to sell, precise locations, right? Again, when to buy and when to sell. Advanced technical analysis, we teach the most comprehensive technical analysis that, and this is the reviews from the traders that are already enrolled into the program. They're saying that this is the most comprehensive technical analysis course that they had, and you're getting this included with this course. And how to apply technical analysis on charts, and how technical analysis is going to help you achieve these goals. With the course, we have the recordings included for all of the days. So all the course is recorded and it's yours to keep. You're not going to keep it just for a month or 2 months and then we're going to cut you off. No, you can download it to your computer and have it forever. We provide you with the e-manual, which is close to 400 pages, if not even more. More than that. We have members only lectures almost every single day in the trading room, and that's continuing education from the class. We have group mentorship sessions. We're also offering you the platform layout, because you need to have a winning platform and not toggle charts when you should be just reading price action. You have unlimited free retakes. So every month when we have a course, you come to the class and we teach you how to trade it. We have support throughout your learning process, risk charts, and more that are going to help you achieve consistency in trading. We provide this class, and we also provide you access until the end of the year with a special offer that we have today. And by the way, this special offer is going to be gone tomorrow night. So we close the door tomorrow night. Let's hope that we're going to have the seats available till tomorrow night. The class is live October 26th through October 30th. It's from 6 to 8 p.m. Eastern. It's a 5-day course online. You're going to have access to the trading room.